Disclaimer.
Today is February 10th, 2026, and silver is trading at $82.63 per ounce. Sounds pretty normal, right? Here's the thing. Just 12 days ago, that same ounce of silver would have cost you $121. And exactly 1 year ago, $30. We're talking about a 300% surge in 12 months, followed by a 32% crash in a single week. And now a recovery that has everyone from Wall Street traders to basement stackers asking the same question: what on earth is actually happening? But here's where it gets interesting. All of this chaos, all of this volatility, all of these wild swings that have made and destroyed fortunes in a matter of days, it's all happening against the backdrop of a single image. A map that the President of the United States posted on Truth Social. An AI-generated map showing something that would have been unthinkable just a few years ago. Canada, Greenland, and Venezuela, all colored in with the stars and stripes of the American flag. Now, before you dismiss this as political theater or social media trolling, I need you to pay attention to something. Because what I am about to show you connects that map directly to the price of silver sitting in your safe, the value of your retirement portfolio, and the purchasing power of every dollar in your wallet. Let me walk you through the timeline, because the sequence of events tells a story that mainstream financial media has completely missed. On January 3rd, 2026, United States military forces entered Venezuela and captured President Nicolas Maduro. The president announced that America would be running Venezuela for the foreseeable future. Silver, which had been hovering around $73, immediately jumped to $76. Most people wrote it off as a knee-jerk reaction. They were wrong. Between January 18th and 21st, the administration began floating tariff threats, specifically targeting Greenland. Silver didn't just move, it rocketed to new record territory, pushing toward $94 and beyond. By January 29th, silver hit its all-time high of $121 per ounce. Stackers who had been accumulating for years were suddenly sitting on small fortunes. Then came the crash. Between February the 5th and 6th, silver plummeted to the $75 to $77 range. Panic selling, margin calls, liquidations cascading through the system like dominoes falling in slow motion. By February 9th, we saw a recovery back to $83.88. And today, as I record this, we're consolidating at $82.63, down about 1.5% from yesterday. So what's the official explanation? Treasury Secretary Scott Bessent went on record attributing these extreme swings to Chinese traders, describing the January peak as nothing more than a speculative blow-off. The narrative they want you to believe is simple. Foreign speculators got carried away, the bubble popped, and now we're returning to normalcy. Pop quiz. Do you actually believe that? Because here's what that explanation conveniently ignores. 3 territories, 3 massive resource plays, one unmistakable pattern that connects them all directly to the precious metals you and I care about. Let's start with Venezuela. Most Americans know Venezuela has oil. What most people don't realize is the scale we're talking about. Venezuela sits on 303 billion barrels of proven crude reserves. That's roughly 1/5 of the entire world's global oil supply, concentrated in a single country that's now under American operational control. But oil isn't the only thing buried beneath Venezuelan soil, and we'll get to that shortly. Now consider Greenland. This frozen island that most Americans couldn't find on a map has suddenly become the most strategically important piece of real estate on the planet. According to geological surveys, Greenland holds an estimated 36 million tons of rare earth elements. That makes it the 3rd largest known rare earth deposit on land anywhere in the world. But it doesn't stop there. Greenland also contains significant deposits of copper, graphite, gallium, tungsten, zinc, gold, and yes, silver. We're talking about a treasure chest of critical minerals that the modern economy literally cannot function without. And then there's Canada, our neighbor to the north, our largest trading partner, the country that shares the longest undefended border in human history with us. Canadian silver reserves exceed 4,700 tons. That's several hundred million ounces of silver sitting in Canadian ground. Canadian miners already contribute over 20% of the world's total mined silver supply. When you buy silver from American dealers, there's a very good chance it came from a Canadian mine. Think about this scenario for a moment. Imagine you're sitting in a boardroom and someone lays out a map showing where the critical resources for the next century are concentrated. Oil that powers the current economy. Rare earths that enable everything from fighter jets to electric vehicles to the smartphone in your pocket. Silver. That's essential for solar panels, electronics, medical equipment, and serves as humanity's oldest form of real money. Now imagine that same person tells you 3 specific territories control the lion's share of these resources, and all 3 are within reach. That map the president posted isn't a joke. It's not trolling, it's a blueprint. And the $100 silver moment we witnessed in January? That wasn't irrational speculation driven by Chinese day traders, no matter what the Treasury Secretary wants you to think. That was the market doing what markets do. pricing in what was coming before the rest of the world catches on, have you noticed how quickly the mainstream narrative shifted from silver is boring to silver is in a speculative bubble to silver crashed because of foreign manipulation? Each of these headlines serves a purpose. Each one is designed to keep regular Americans confused, reactive, and on the sidelines, while the real repositioning happens behind closed doors. Here's what should grab our attention right now. Silver is up over 160% from where it traded a year ago. Even after the crash, even after all that volatility, the trend remains firmly intact. Year to date, as of today, silver is still up 16%. The fundamentals driving this move haven't changed one bit. What changed was the paper market mechanics, and understanding that difference could be worth a small fortune to anyone paying attention. The map shows us something that goes far beyond traditional investment analysis. It reveals a strategic repositioning of American resource control that will reshape global supply chains, currency relationships, and commodity prices for decades to come. Venezuela gives us energy independence on a scale we've never had. Greenland gives us the rare earth minerals currently strangled by Chinese monopolies. Canada gives us the silver, copper, and other base metals that make industrial civilization possible. 3 territories, trillions of dollars in resources, one pattern hiding in plain sight. But here's what they won't tell you on CNBC or Bloomberg or any of the usual financial channels. The crash from $121 down to $75 was not caused by Chinese speculators getting carried away. It was engineered. There were specific triggers, specific policy announcements, and specific market mechanisms that combined to create exactly the kind of shakeout that transfers wealth from weak hands to strong ones. And in part 2, I'm going to show you exactly how it happened, who benefited, and why stackers who understand this mechanism should be paying very close attention to what comes next. Because the same forces that pushed silver to all-time highs are still in play, and the same forces that crashed it are running out of ammunition. Let me show you something the mainstream completely missed. When silver crashed from $121 to $75 in a matter of days, every financial talking head had the same explanation ready to go. Chinese speculators got too greedy, the bubble popped. Nothing to see here, folks. But if you actually dig into what triggered that collapse, you will find a very different story. One that reveals how paper markets can be weaponized against physical asset holders, and why understanding this mechanism matters for everyone who stacks precious metals. The first domino fell with a single nomination. In late January, the administration nominated Kevin Warsh to become the next chairman of the Federal Reserve. Now, if you're not familiar with Warsh, here's what you need to know. This is a man who has been vocally, consistently, and aggressively opposed to a large Federal Reserve balance sheet. He's on record criticizing the money printing that's been propping up our financial system since 2008. The moment his nomination was announced, traders immediately began pricing in a more hawkish Fed. Higher interest rates, tighter monetary policy, and less of the easy money that's been fueling the precious metals rally. But here's where it gets interesting. The Warsh nomination didn't happen in isolation. Almost simultaneously, the exchanges raised margin requirements on silver futures contracts. What does that mean in plain English? It means that traders who were using leverage to bet on silver suddenly needed to put up more cash to maintain their positions. And when you force leveraged traders to come up with more money on short notice, many of them can't do it. They're forced to sell, not because they want to, not because the fundamentals changed, but because the rules of the game shifted underneath them. This triggered the third phase, the leveraged ETF unwind. Between February 1st and February 5th, the mechanical selling from these forced liquidations cascaded through the entire system. Algorithms triggered more algorithms. Stop losses triggered more stop losses. And silver, which had been climbing on genuine supply-demand fundamentals, suddenly cratered on pure paper market mechanics. Here's the translation that matters. The fundamentals never changed. Not one silver mine closed. Not one solar panel manufacturer stopped buying. Not 1 ounce of physical silver suddenly appeared out of thin air. The paper market broke. The paper market that exists on computer screens and in derivative contracts. Physical silver? It didn't move. Try buying actual silver during that crash, and you would have found premiums holding steady or even increasing, while the spot price on your screen showed a collapse. By the end of that week, silver had rebounded towards $78 as markets began to recognize something important. According to analysts covering the move, the sell-off was driven by overdone speculative positions, not by any change in the solid fundamentals underlying the silver market. The smart money understood what happened. The question is whether you do too. Now let me take you deeper into the evidence behind that map. Because what's happening isn't just about market manipulation, it's about the largest repositioning of resource control in modern American history. Let's start with Canada, the silent giant that most people completely overlook. When Americans think about silver, we tend to think about Nevada or Mexico, but Canadian silver miners contribute over 20% of the entire world's mined silver supply. That's not a rounding error, that's a strategic position. And according to industry analysts tracking the 2025-2026 outlook, the bullish case for silver remains firmly intact, especially with expanding applications in green energy technology and advanced manufacturing. Canada is positioned as one of the most reliable suppliers on Earth, operating under stable governance with existing infrastructure and established trade relationships with American buyers. But here's the hidden leverage that most investors miss entirely. Much of Canada's silver production comes as a byproduct of gold and copper mining. When gold prices rise, miners dig more gold ore, and they pull silver out of the ground along with it. When copper prices rise for electric vehicle production, same story. Silver supply increases as a secondary effect. This creates a fascinating dynamic where silver benefits from multiple commodity bull markets simultaneously, and Canadian miners sit at the center of all of it. Now consider Greenland, the Arctic prize that's suddenly become the most contested piece of real estate in the Northern Hemisphere. Everyone's talking about Greenland's rare earth deposits, and for good reason. It holds the world's third largest known land-based rare earth supply. The mineral's essential for everything from fighter jet guidance systems to smartphone screens to MRI machines. But the rare earths are just the headline. Dig deeper into the geological surveys and you find something remarkable. Amaroq Minerals, one of the leading mining operations in Greenland, recently announced what their CEO called a short-term solution in mining terms. They're preparing to extract zinc, lead, silver, and germanium while simultaneously developing export capacity for rare earths. Read that again. Silver is part of Greenland's near-term mining plan, not some distant future possibility. And it gets more strategic from there. In addition to those rare earth supplies, Greenland boasts extensive deposits of germanium and gallium, two critical minerals that most Americans have never heard of, but that our entire technology sector depends upon. These elements are essential for semiconductors, fiber optics, solar cells, and military applications. Without them, our tech industry grinds to a halt. Trump administration officials have been explicit about their motivation here. They view Greenland's underground riches as a way to loosen China's stranglehold over the rare earth metals critical for fighter jets, lasers, electric vehicles, and MRI scanners. This is not speculation about intent. This is stated policy from people in the room where decisions are being made. Which brings us to Venezuela, and a dimension of this story that almost nobody is discussing. Yes, Venezuela has oil, 300 billion barrels of it, but Venezuela also boasts Latin America's largest gold reserves and ranks among the top global holders of iron ore and bauxite. The country contains significant deposits of rare earth elements and other critical minerals that have never been fully developed because of decades of mismanagement and political instability. Here's what reveals the true strategic thinking. When our government imposed sanctions on Venezuela, they didn't just target oil exports or political officials. According to Treasury Department documentation, United States sanctions explicitly target persons operating in the gold sector of the Venezuelan economy. Think about that for a moment. We specifically went after gold operations, not as a side effect of broader sanctions, but as a deliberate, targeted policy choice. Controlling gold flows isn't incidental to the Venezuela strategy, it's central to it. Now we need to talk about why all of this matters beyond our borders, and that means talking about China. According to industry data, China currently controls around 98% of global gallium supplies and approximately 60% of germanium production worldwide. Beijing controls roughly 90% of global rare earth refining capacity, giving the Chinese Communist Party strategic leverage over supply chains that affect every advanced economy on Earth. This concentration didn't happen by accident. While American policymakers spent decades focused on other priorities, China systematically invested in mining, processing, and refining capacity for the minerals that modern technology requires. They played a long game, and they played it brilliantly. Today, if China decides to restrict exports of these critical materials, which they've already done in response to trade tensions, American manufacturers face immediate supply disruptions with no easy alternatives. Greenland represents the most viable path to breaking that dependency. China knows this, which is why Beijing has maintained its own interest in Greenland for years. Chinese companies have attempted investments in Greenland mining operations, and China's global lead in rare earth processing keeps them positioned as a potential partner for Greenland development, a scenario that would be strategically catastrophic for American interests. This is the context that explains why the administration is willing to take aggressive, unprecedented action on 3 different territorial fronts simultaneously. Venezuela secures energy resources and gold reserves. Greenland secures rare earths and critical minerals. Canada secures silver, copper, and stable supply chains. Together, they represent a complete repositioning of American resource independence for the coming century. And silver sits at the exact center of this transformation. Silver is essential for solar panel production. You cannot build the green energy future without it. Silver is critical for electronics manufacturing, medical equipment, water purification, and dozens of industrial applications that most people never think about. Silver is also the oldest form of monetary metal, recognized as real money across every culture and civilization in human history. When confidence in paper currencies wavers, silver provides a store of value that no government can print into existence. What we're witnessing isn't about one country or one commodity or one political decision. It's about who controls the supply chain for the next industrial revolution. Rare earths for advanced technology, oil for energy transition, gold for monetary reserves, and silver, sitting quietly at the intersection of industrial demand and monetary history, positioned to benefit from every single trend driving this transformation. The January crash wasn't the market rejecting silver's fundamentals. It was the paper market being used to shake out weak hands before the next leg higher. And in part 3, I'm going to show you exactly what the numbers tell us about where silver is headed, including specific price targets that the big banks are quietly publishing while their television analysts tell you to stay away. Now we get to the part that actually matters for your portfolio, the math. There's a number that professional precious metals traders watch more closely than almost any other metric, and most retail investors have never even heard of it. It's called the gold to silver ratio, and as of today, February 10th, 2026, it stands at 61 to 1. That means it takes 61 ounces of silver to buy 1 ounce of gold at current prices. Sounds like trivia, right? Here's why it's anything but. Throughout history, this ratio has fluctuated dramatically based on monetary conditions, industrial demand, and investor sentiment. Back in 1980, during the last great precious metals bull market, the ratio compressed all the way down to 15 to 1. Silver didn't just keep pace with gold during that run, it dramatically outperformed, multiplying in value while gold merely doubled. When the ratio compresses, silver wins. And right now at 61 to 1, we're nowhere near those historic compression levels. What does that mean in practical terms? It means silver remains significantly undervalued relative to gold, even after a 300% move over the past year. It means the trend is not only intact, but potentially has enormous room to run. And it means that the 32% crash from January's all-time high might represent something very different than what the financial media wants you to believe. Not the end of the silver story, but a gift-wrapped entry point for anyone paying attention. Let me put some concrete numbers on this so you can see what we're actually looking at. Julia Du, senior commodities strategist at ICBC Standard Bank, one of the largest banks in the world, recently published a forecast that should have made headlines but barely registered in American financial media. Her analysis sees gold prices potentially pushing as high as $7,150 per ounce, not as a wild speculation, but as a researched price target from a major institutional strategist. Now apply the ratio math. If gold reaches that 7150 level and the gold-silver ratio compresses to even a modest 40 to 1, nowhere near the 15 to 1 extreme we saw in 1980, silver would need to trade at approximately $179 per ounce to maintain that relationship. That's more than double today's price of $82. But let's be conservative about this, because I want to give you scenarios you can actually plan around. In a conservative scenario, let's assume gold reaches $5,500, a level that multiple major banks have already forecasted, and the ratio only compresses to 55 to 1. That puts silver right at $100 per ounce. Not a moonshot, not a fantasy. Just simple math based on published institutional forecasts and modest historical ratio compression. In a base case scenario, gold hits $6,000 and the ratio compresses to 50 to 1. That's a silver price of $120, essentially a return to January's all-time high, but this time as a sustainable level rather than a speculative spike. And in a bull case, gold at 7150 with a ratio of 40 to 1 gives us that $179 silver target. That's the scenario where everything the map represents actually plays out. American resource dominance, dollar weakness, and a flight to hard assets that makes the 1970s look like a warm-up act. Here's what you need to understand about timing, because price targets without timeframes are just wishful thinking. February 2026, right now, this month, represents a critical inflection point. We have tariff threats creating uncertainty in international trade relationships. We have legitimate concerns about Federal Reserve independence with a new chairman nominee who is openly hostile to the current monetary framework. We have tensions in the Middle East that could escalate at any moment. And we have precious metals that just experienced their first significant correction after a historic run-up. Bank of America, not some newsletter writer, not some YouTube personality, but Bank of America, has published research forecasting gold could hit $6,000 by spring of 2026. Their thesis? That people are losing faith in conventional investments and rotating into hard assets. Goldman Sachs, meanwhile, predicts gold will end this year at $5,400. These aren't fringe predictions. These are the base cases from two of the most influential financial institutions on Earth. And here's the thread that ties everything together. Analysts have started using a term that perfectly captures what is driving this entire move: the debasement trade. The debasement trade refers to an investment strategy where capital flows out of currencies and into scarce assets like gold and silver. It's driven by fears of volatility in government-issued money and anxiety about exploding government debt levels. When investors lose confidence in paper, whether that's dollars, euros, yen, or any other fiat currency, they seek safety in things that cannot be printed, cannot be debased, and have maintained value across centuries of monetary chaos. That map the president posted, the one showing Canada, Greenland, and Venezuela under American influence, that's what a superpower does when it's preparing for a post-dollar world, not abandoning the dollar, repositioning for a future where resource control matters more than reserve currency status. Venezuela provides energy security and gold reserves. Greenland provides the rare earths and critical minerals that technology requires. Canada provides the silver, copper, and stable supply chains that keep industry running. 3 territories, trillions in resources, 1 currency under pressure. Now, I believe in giving you the complete picture, which means acknowledging the risks that could derail this thesis. First, if the United States and European allies quickly resolve the Greenland situation through diplomatic channels, the urgency driving precious metals could evaporate rapidly. Fear is a powerful motivator for gold and silver buying, and if that fear dissipates, prices could pull back significantly. Second, Greenland mining is not an overnight solution. Industry experts have been clear that it would take at least a decade before meaningful production comes online from new Greenland operations. The strategic value is real, but the timeline for actual resource extraction is measured in years, not months. Third, policy reversals remain a constant risk. Precious metals rallied hard when the administration hinted at efforts to weaken the dollar. If that policy direction changes, if the Fed surprises with a dovish pivot, if international tensions de-escalate across multiple fronts simultaneously, any of these could trigger short-term volatility that shakes out leverage positions, just like we saw in early February. Short-term price movements in precious metals can be violent and unpredictable. The 32% crash from January's peak is proof of that reality. Anyone treating silver as a get-rich-quick trade rather than a strategic position is setting themselves up for disappointment. But here's what the risk analysis misses when you zoom out to the bigger picture. The structural forces driving precious metals higher haven't changed. Government debt continues to compound. Central banks around the world are buying gold at record levels. Not selling, buying. Industrial demand for silver keeps growing as solar installations expand and electronics manufacturing increases. And the geopolitical repositioning revealed by that map is not going to reverse because of one diplomatic meeting or one policy announcement. Silver at $82 today is considerably lower than the $121 it commanded just 12 days ago. According to analysts covering the precious metal space, this represents a timely opportunity for investors before the price trend reverses course and heads back toward those highs. The crash gave you something rare in financial markets, a second chance. The question is not whether the fundamental case for silver remains intact. The evidence we've covered makes that clear. The question is whether you'll recognize this opportunity for what it is, or whether you'll wait for the mainstream media to finally acknowledge what's happening after the move has already occurred. Think about what that map really represents when you strip away the political theater and social media controversy. America is repositioning for a future where controlling physical resources matters more than manipulating interest rates, where rare earth minerals determine technological supremacy, where energy independence isn't just a slogan, but a strategic necessity, and where precious metals, real, physical, hold-in-your-hand assets, serve as the foundation for whatever monetary system emerges from the current uncertainty. The $100 silver map isn't about today's price. It's about where we're headed. 3 territories containing the resources that will define the next century. One pattern that connects energy, technology, and money in ways that most investors haven't begun to understand. And one metal, silver, sitting at the intersection of industrial necessity and monetary history, still undervalued by historical measures despite a 300% run. The institutions are positioning, the governments are repositioning. The only question left is whether you are. If this analysis helped you see the bigger picture, if it connected dots that the mainstream financial media refuses to acknowledge, then subscribe and hit that notification bell so you don't miss what comes next. This story is still unfolding, and the implications for your portfolio, your purchasing power, and your financial future are just beginning to become clear. Drop a comment below and tell me, at what price did you start stacking? And more importantly, are you still adding on these dips? Because the people who understand what that map really means aren't waiting for permission from CNBC to protect their wealth. The pattern is clear. The evidence is documented. The opportunity is now.